Let me start with a hard truth most people don't like to hear. Investing isn't about excitement, hype, or chasing the next shiny thing. It's about discipline, it's about rules, and it's about respecting money enough to make it work for you instead of disappearing one bad decision at a time. The big secret for small investors is this: you don't need to be brilliant, lucky, or early. You need to be consistent and selective. Small investors lose because they treat investing like entertainment. They buy stories instead of cash flow. They fall in love with ideas instead of numbers. And emotion is the most expensive habit you can have in the market. Winning starts with understanding one simple principle: money is a tool, not a trophy. Every dollar you invest has one job: to produce more dollars. If it doesn't do that reliably, it doesn't belong in your portfolio. Period. You are not here to impress anyone. You are here to build something that lasts. Small investors should think like owners, not gamblers. That means you invest in businesses that actually make money, return capital, and respect shareholders. You look for predictable revenue, strong margins, and management that treats profits like oxygen. If a company can't explain how it makes money in one sentence, walk away. Another mistake small investors make is trying to get rich fast. That mindset is poison. Wealth is built slowly, deliberately, and boringly. Compounding doesn't care about your emotions or your impatience. It rewards time, reinvestment, and restraint. You don't swing for home runs. You stack base hits and let time do the heavy lifting. Risk is not volatility. Risk is losing your capital permanently. So you manage risk by diversifying, by setting rules, and by never investing money you can't afford to leave alone. You don't check your portfolio every hour. You don't panic on bad days. You trust your process, not the noise. And here's where small investors actually have an advantage. You can move quickly, you can be focused, you can avoid ego-driven decisions that destroy large portfolios, you can say no more often than yes, you can demand profitability, dividends, and accountability from every dollar you deploy. Investing to win isn't about being smarter than everyone else. It's about being calmer, more disciplined, and more patient than most people are willing to be when real money is on the line. Investing is discipline, not entertainment. Successful investing requires rules, patience, and emotional control. Chasing hype, trends, or exciting stories leads to losses, while consistency and logic build wealth. Every dollar must work. Money is a tool with one purpose: to generate more money. If an investment doesn't produce reliable returns or cash flow, it doesn't deserve a place in your portfolio. Think like an owner, not a gambler. Small investors win by focusing on profitable, well-run businesses with clear revenue, strong margins, and management that respects shareholders. Wealth is built slowly through compounding. Trying to get rich quickly destroys capital. Long-term growth comes from patience, reinvestment, and allowing compounding to work over time. Risk management is the real advantage. True risk is permanent loss, not market fluctuations. Diversification, clear rules, and emotional restraint give small investors a powerful edge. Most people approach investing the same way they approach entertainment. They want excitement, fast results, and a good story to tell. That mindset is exactly why so many portfolios quietly bleed over time. Investing was never designed to be thrilling. If it feels like a rush, if it makes your heart race, you're probably doing it wrong. Discipline is boring, and boring is profitable. When investors chase excitement, they stop thinking and start reacting. A flashy headline, a viral post, a friend bragging about a quick win. Suddenly, logic is replaced by fear of missing out. That emotional reaction leads to buying high, selling low, and repeating the cycle over and over again. Markets don't punish ignorance as much as they punish impulsiveness. The investor who reacts emotionally is handing control of their money to the noise. Discipline means having rules before you invest a single dollar, not after the market drops, not when panic sets in. Before, rules protect you from yourself. They force you to slow down, analyze, and decide based on facts instead of feelings. When you know exactly why you're buying, when you'll add more, and when you'll exit, the market loses its power to scare you. Entertainment-driven investors want constant action. They check prices every hour. They trade too often. They mistake movement for progress. In reality, most of the wealth in markets is created by doing less, not more. The disciplined investor understands that time in the market beats timing the market. They let strong investments breathe. They allow businesses to grow, cash flows to compound, and value to accumulate quietly. Another trap of treating investing like entertainment is falling in love with narratives. Stories sell. A revolutionary product, a charismatic founder, a promise of changing the world. None of that matters if the numbers don't work. Discipline forces you to ignore the story and focus on fundamentals: revenue, profitability, margins, balance sheets, cash flow. These are not exciting words, but they are the language of wealth. Discipline also means accepting that you will not catch every opportunity, and that's fine. You don't need to. Missing out is not a failure. Chasing everything is. The disciplined investor waits for opportunities that fit their criteria and ignores the rest. Saying no is not weakness, it's strength. Every no protects capital for the right yes. Markets will test your discipline constantly. There will be crashes that make you question everything. There will be rallies that tempt you to abandon your rules. The disciplined investor understands that volatility is normal. Panic is optional. When you treat investing as a serious, long-term process instead of a form of entertainment, short-term chaos loses its influence. At its core, discipline is about respect. Respect for money, respect for risk, respect for the fact that wealth is built through consistency, not excitement. The investor who stays disciplined when others chase thrills is the one who quietly wins while everyone else wonders where their money went. Most people treat money like a reward, something to spend, show off, or feel good about owning. Investors who win see it differently. Money is not emotional, and it's not personal. It's a tool. And like any tool, if it's not being used properly, it's being wasted. Every dollar you invest should have a clear purpose, and that purpose is simple. It must generate more dollars. When money sits idle or is placed into something that doesn't produce returns, it slowly loses power. Inflation eats it away. Poor decisions drain it. Hope does nothing for it. The investor who understands this stops asking how exciting an investment is and starts asking how effective it is. Does it produce income? Does it grow in value? Does it protect purchasing power over time? If the answer is unclear, the dollar is unemployed. Successful investors assign responsibility to every dollar. They don't scatter money randomly across ideas, trends, or tips. They expect performance. That means measurable returns, predictable behavior, and a reasonable understanding of how those returns are created. If a business cannot explain how it turns capital into profit, it doesn't deserve your capital. Money without accountability disappears quietly. This mindset also eliminates emotional attachment. You don't fall in love with an investment. You don't defend it when the facts change. You don't keep it because of pride or nostalgia. A dollar that stops working gets replaced. That's not cruelty, that's efficiency. Capital has no loyalty, and neither should you. Your responsibility is not to your opinions, but to your outcomes. Small investors often make the mistake of thinking size limits opportunity. In reality, size increases responsibility. When you have limited capital, every decision matters more. You cannot afford dead money. You cannot afford long-term promises with no short-term discipline. The smartest move is demanding that each investment earns its place by producing value, not potential. Working money doesn't always mean fast growth. Sometimes it means steady income. Sometimes it means protecting capital while earning modest returns. What matters is that the dollar is active, not passive in the wrong way. Passive investing still requires active thinking. You choose where the money goes, what it's expected to do, and how long you'll tolerate underperformance. This approach also changes how you measure success. You stop obsessing over price movements and start focusing on output, cash flow, dividends, earnings growth. These are signals that money is doing its job. Noise fades when performance speaks clearly. A portfolio built on working dollars doesn't need constant attention because it's designed to function without drama. When every dollar has a job, you become more selective, more patient, and far less vulnerable to hype. You don't chase excitement because excitement doesn't pay. You chase results. You build a portfolio that behaves like a system, not a collection of guesses. And over time, that system compounds quietly, efficiently, and relentlessly. Because money that works consistently will always outperform money that merely looks impressive. Most people who lose money in the market aren't investing at all. They're speculating. They place bets, cross their fingers, and hope the market rewards their courage. That's not ownership, that's gambling with better vocabulary. Real investors think like owners because ownership forces responsibility, patience, and clarity. When you own something, you care about how it operates, not just what someone else might pay for it tomorrow. An owner wants to know how a business makes money, how stable that money is, and how efficiently it's managed. A gambler only cares about price movement. That difference in mindset separates long-term winners from short-term losers. Thinking like an owner means focusing on businesses, not tickers. A stock is not a lottery ticket. It represents a real company with employees, customers, expenses, and obligations. If you wouldn't be comfortable owning the entire business, you shouldn't be comfortable owning a single share. Ownership requires understanding, and understanding reduces unnecessary risk. Owners pay attention to cash flow because cash flow is reality. Profits on paper can be adjusted, explained away, or delayed. Cash tells the truth. A business that consistently generates cash can survive bad markets, invest in growth, and reward shareholders. A business that burns cash relies on optimism, and optimism is not a strategy. Another owner's habit is demanding respect for shareholders. Management, whoa. Our case for the owners, not the other way around. When executives dilute shares excessively, avoid profits, or chase vanity projects, they are spending someone else's money. Owners don't tolerate that. They expect discipline, transparency, and returns. If management treats capital casually, owners walk away. Gamblers chase stories, owners analyze systems. A compelling narrative might attract attention, but it doesn't guarantee sustainability. Owners want repeat customers, predictable revenue, and defensible margins. They want to know what happens when the economy slows, when competition increases, and when costs rise. Businesses that survive pressure are the ones worth owning. Thinking like an owner also changes how you respond to volatility. Price drops don't automatically signal danger. They signal opportunity or mispricing if the business remains strong. Owners don't panic when markets fluctuate because they're focused on operations, not opinions. If the fundamentals are intact, lower prices can mean better value. Small investors often underestimate their advantage here. You don't have to answer to committees or justify decisions to anyone else. You can be selective. You can avoid businesses that don't meet your standards. You can hold quality longer than institutions constrained by size. That flexibility is powerful when paired with an ownership mindset. Ownership also requires patience. Businesses don't transform overnight. Strategies take time to execute. Earnings compound gradually. The owner understands this and allows time to work. The gambler demands instant gratification and exits at the first sign of discomfort. When you think like an owner, investing stops feeling stressful. Decisions are grounded in logic, not hope. You know why you own what you own. You know what would make you sell, and you're no longer dependent on market mood swings to validate your choices. Because your confidence comes from understanding the business itself. Most people underestimate how long real wealth takes to build, and that misunderstanding costs them everything. They want fast results, dramatic gains, and instant proof that they're right. Markets don't reward impatience, they punish it. The desire to get rich quickly pushes investors toward excessive risk, poor timing, and fragile strategies that collapse under pressure. Wealth is not created in a moment. It's created through repetition, small, intelligent decisions made consistently over time. Compounding is not exciting in the early years. In fact, it's almost invisible. That's why so many people abandon it before it ever has a chance to work. They mistake slow progress for failure and chase shortcuts that destroy capital. The power of compounding comes from reinvestment in time, not brilliance. You don't need extraordinary returns to win. You need reasonable returns sustained over long periods without interruption. Every time you panic, sell, or reset your strategy, you break the compounding engine. The investor who stays invested through cycles allows gains to build on gains quietly and relentlessly. Trying to get rich fast also distorts decision-making. It encourages concentration in speculative assets, overtrading, and ignoring risk. These strategies might work briefly, but they don't survive long-term. Sustainable wealth requires durability. It requires investments that can survive economic downturns. rising interest rates, and unexpected shocks. Speed sacrifices durability, and durability is where real wealth lives. Patience is not passive, it's strategic. Long-term investors are constantly evaluating quality, adjusting positions thoughtfully, and reinvesting profits. They are active in process but calm in behavior. They understand that boredom is a feature, not a flaw, a bow. Ring portfolio that compounds steadily will outperform a thrilling one that constantly resets itself. Another overlooked aspect of slow wealth building is behavior during setbacks. Losses are inevitable. Markets correct. Businesses stumble. The difference is how investors respond. The patient investor sees downturns as part of the process, not a personal failure. They stay focused on fundamentals instead of reacting emotionally to short-term pain. Time also smooths out mistakes. No investor is perfect. But when decisions are made with discipline and allowed to compound, good choices outweigh bad ones. Impatience magnifies errors. It forces action at the worst possible moments. Patience gives your best decisions room to dominate your results. Small investors often think they're at a disadvantage because they lack capital. In reality, time is their greatest asset. Starting early, staying consistent, and reinvesting returns gives them an edge that no amount of short-term speculation can match. The market rewards those who respect its timelines, not those who try to rush it. Slow wealth doesn't attract attention. It doesn't create dramatic stories. But it creates freedom, stability, and control. The investor who commits to steady compounding, ignores the noise, and resists the urge for instant gratification builds something far more powerful than quick profits, something that endures through cycles, headlines, and uncertainty. Most people misunderstand risk because they focus on price movement instead of outcomes. They see volatility and assume danger, when in reality, volatility is just noise. Prices move every day for reasons that have nothing to do with long-term value. Real risk is not seeing your portfolio fluctuate. Real risk is losing your capital in a way that it never recovers. Permanent loss happens when investors ignore fundamentals, overconcentrate, or refuse to admit mistakes. It happens when emotion overrides structure. A portfolio built without risk management might look impressive during good times, but it collapses when conditions change. Managing risk is not about avoiding losses entirely. It's about ensuring no single mistake can destroy everything you've built. Diversification is not about owning everything. It's about avoiding dependence on any one outcome. When your entire future is tied to a single idea, product, or market, you're not confident, you're exposed. Spreading capital across different businesses, sectors, and income sources reduces the impact of failure. It gives you room to be wrong and still survive. Rules are another critical defense against risk. Rules determine position size, entry points, exit criteria, and acceptable loss. Without rules, decisions are made emotionally in moments of stress. With rules, decisions are made calmly in advance. The market doesn't care how smart you are, but it will punish inconsistency every time. Small investors often have an advantage here because they can be disciplined without external pressure. They don't have to chase benchmarks or justify risk to others. They can choose safety over ego. They can walk away from opportunities that don't offer enough margin of safety. That freedom, used correctly, dramatically reduces downside exposure. Another misunderstood aspect of risk is leverage. Borrowed money magnifies outcomes, but it magnifies mistakes first. Leverage removes time from the equation. It forces decisions under pressure and turns normal volatility into catastrophic loss. Investors who respect risk treat leverage with extreme caution if they use it at all. Emotional control is also a form of risk management. Panic selling locks in losses. Overconfidence leads to reckless bets. Fear and greed destroy more wealth than bad analysis ever could. Managing risk means managing behavior. The investor who stays calm when others panic preserves capital and gains opportunities when prices disconnect from reality. Risk management also means knowing what you don't know. No one can predict markets consistently. Accepting uncertainty leads to humility, and humility leads to protection. You build buffers, you demand quality, you avoid fragile investments that only work under perfect conditions. When risk is controlled, returns take care of themselves. You don't need extraordinary wins if you avoid devastating losses. Survival is the foundation of success. The investor who stays in the game through multiple cycles compounds experience, confidence, and capital. Over time, that consistency becomes a competitive advantage, allowing small investors to outperform not by being aggressive, but by being deliberate, patient, and prepared. In the end, winning as a small investor has nothing to do with luck, hype, or secret formulas. It comes down to how you think, how you behave, and how seriously you treat your money. Discipline over excitement, cash flow over stories, ownership over speculation, patience over speed, risk control over ego. Master those principles, apply them consistently, and you stop reacting to the market, you start using it. That's how small investors don't just survive, but steadily build real, lasting wealth while everyone else keeps chasing noise.